Being self-employed should not be a disadvantage when applying for a mortgage, but to most lenders, it is. And this is because they don't know how to look at your income correctly, whether you're an entrepreneur, freelancer, or you get 1099s. There are alternate methods that are way better suited for you. If you go the traditional route, you could get denied, overpay, and lose your shot at a home altogether. Wouldn't that suck? I'm Andrew Russell, a mortgage specialist who helps self-employed clients, entrepreneurs buy the home of their dreams and not have to show their W-2s, their tax returns, and just put up with the frustrations of conventional loans. I recently had a client refer to me whose name was Tommy, and Tommy was an entrepreneur, living the dream, a businessman who was a 50% partner in a company that sold high-end furniture and high-end appliances. Say you go to a cool backyard in the Hamptons and you see this crazy barbecue and you wonder that, wow, this person must spend $50,000, $100,000 for this outdoor kitchen. Tommy was the guy that they called. Now the problem is that Tommy wanted to buy a house, thought he had 20% down. What could possibly go wrong? Great credit. Showed his tax returns to the big bank, of course, who he banks with, and they said a big fat womp, womp, womp. No. Why? Because although Tommy got a big distribution at the end of the year, his accountant, who was very good, had certain write-offs, so that $300,000 distribution that he thought that he made, there was a $400,000 loss somehow with the business. I'm sure it made sense to the IRS. But with that said, he actually showed a loss for the year, even though in his head he had a gain. So what did we do? Instead of using the big bank, he was referred to us, a company that specializes in some of these different loan products, specifically a bank statement program. And we looked at the last 12 months of his business bank statements, and it showed a huge, huge revenue coming out. I think Tommy had, my brain still recollects, was something like $500,000 a month coming in of income. So instead of showing a loss, where you couldn't obviously purchase if you're showing a loss naturally, going a conventional route, on a bank statement program, $500,000 a month in deposits, which was consistent over 12 months, which is crazy. Half owner, so that's $250,000 goes to him. Then we use a 50% expense ratio, so it's $125,000 worth of income. He would have qualified if he wanted, which is nuts, up to a $60,000 mortgage payment. So it just goes to show you, if you go the vanilla route on a conventional or portfolio loan with the big banks, he would have qualified for nothing. If you go the non-QM, the bank statement route, he would have qualified for up to a $60,000 mortgage payment, and he wanted nothing close to that. But I keep saying, hey, Andrew, I'm sure that portfolio loan or that jumbo loan with the big bank would have been priced so much better. No, it's not the case. With the 20% down in the great credit, the interest rate was comparable to what he would have received, but great news, he actually qualified. Or, hey, Andrew, it sounds good, but I'm sure that process is so antiquated. It must take so long for those lenders to close on those loans. It's actually not the case at all. It takes from submission to clear to close 2 to 3 weeks at most. And I can hear you saying now, hey, Andrew, I'm sure this guy Tommy got a horrific interest rate. No, that's actually not the case. The rate he would have got from the big bank, the rate on the bank statement program was comparable within 0.25%, which is really nothing at the end of the day. And of course, it gave Tommy the opportunity to buy his dream home instead of just renting for the rest of his life. And of course, typical haterade, hey, Andrew, probably takes forever to close on these mortgages in an antiquated process. It's actually not the case. It takes typically 2-3 weeks for a clear to close, maybe 4 weeks, which means you can still close in 30 days with these amazing new loan products. And of course, last but not least, tons of haterade. Hey, Andrew, come on, you're lying, broski. All banks look at tax returns. No, it's not the case. Sure, if you're doing a conventional loan or portfolio loan, they're going to look at your tax returns if you're self-employed. But on these non-QM bank statement programs, there's no such thing as a tax return. We look at 12 months bank statements, we take a peek at how long the corporation's been open, we look at the revenue, and that's all we need. All right, so there's a wide gamut of non-QM, self-employed loan products that we could, of course, go over. But we're going to specifically go over right now the 1099 program and why it's so powerful, the bank statement program, and of course then the P&L program. All right, so we're going to show you the typical way of the tax returns, why it didn't work, and then why the 1099 program would have worked, the typical way of looking at tax returns for someone that eventually will look at their bank statements instead, why they got declined, why the bank statement program worked. And then, of course, last, the same thing. They had tax returns, they applied for a mortgage, they got declined, but then eventually needed the actual P&L program, why the P&L program, and why they were able to be approved. All right, so, of course, the red Sharpie is the no bueno one. All right, so the first client we're going to talk about is the 1099 client. And who has a 1099? None other than our besties across the ocean, realtors. So our realtor client right here in 2024, the 1099 in 2024 was, let's just say, 200,000. And let's just say in 2023 as well, it was 200,000. Now, if we break it down in two different ways, way one, of course, the agent is like, hey, I want to buy a house. Walks into a big bank, shows the tax returns. So in 2024, they've been a realtor long enough where we could have gone off a one-year average. That 200,000 revenue, it sounds good, right? That accountant that they had expenses and wrote that $200,000 down, which if you're an agent watching or you're a 1099 client watching, I'm sure this is the case for you if you look at your tax returns. Wrote off about if I remember, about $140,000 in expenses. It could have been leads. It could have been, things that were required. It could have been, staff on their team. Whatever it is, wrote it down to $60,000. So of course they only paid $60,000. They paid tax off making $60,000, but that is $5,000 a month. Even with great credit, no debt, that's a $2,500 mortgage payment, and it just didn't work. So unfortunately, the red marker of death. That takes forever to open. Wait for it. Wait for it. And isn't going to work for this realtor. That was super anticlimactic. There we go. But here comes the 1099 program. So as you can see, guys, the 200,000, 200,000, we can use 90% in this program of the face value of the 1099 and go off no expenses. So that's 180,000, 180,000. So that equates to about $15,000 a month of income. So if you see over here, that 5,000 just tripled the purchasing power income just by going in the right program, which is amazing. Like, again, what's the catch? You're almost like, it makes no sense, Andrew. No, they had a $200,000 revenue. We could do a one-year average of 5 years or more self-employed for conventional, but why didn't it work? Because they wrote off $140,000. There was a one over here. And $60,000 is what they show as a net profit, $5,000 a month, $2,500 max if they're lucky, great credit, and no debt for a mortgage payment. So again, over here, instead of looking at tax returns, we didn't even submit them because they're 1099 program. We do 90% of the 200,000, which is 180 each year. 180,000 divided by 12 is a lot more than 60,000 divided by 12. So it's 15,000 a month in income, assuming great credit, no debt. Even just to be safe, they would qualify for a $6,000 to maybe even a $7,500 mortgage payment. And it turned out, this is something I would believe they wanted an $800,000 house. So they went from being able to purchase probably a $300,000 or $400,000 house all the way up to an $800,000 house just because we put them in the right program. Now that's the first client with a 1099. Now a second client, say they are a drop shipper or, anything where they have revenue coming in every single month, we're going to do the bank statement program. Now, same thing. In 2024 and 2023, this self-employed client, you call them a drop shipper or somebody who owns their own business with revenue coming in, self-employed, obviously an entrepreneur. They made about $480,000 in revenue each year. And that sounds great, but again, option one, so say in this example, as an example, this is an LLC client, taxed as an S Corp. And I'm sure a lot of you guys watching this, or if you're self-employed, a business owner, maybe you're in a partnership, whatever it is, say you get a K1 at the end of the year. So when you think of tax returns, you think of the revenue, say the 480 again, but then there's all the expenses as a corporation. Say that whittles down to a K1 distribution at the end of the year. Your accountant gave you something like, again, $60,000. So between all the expenses, there's about $420,000 of write-offs. Not necessarily all actual expenses. Some are paper expenses, like depreciation and various things. But that's $60,000. In that 480 gets whittled down to only 60 again. That's about $5,000 a month. And again, great credit, no debt. You're maxing out again at a $2,500 mortgage payment. $300,000 to $400,000 house. Not gonna do the trick. We are in the wrong decade, maybe in the wrong century on Long Island, New York, let alone many areas for that to be a plausible thing. So this is a So cathartic, this red marker. Big fat no. So if we look at the bank statements, right, if you have $408,000 a year in revenue, so you divide that by 12, it's about $40,000 a month in revenue. You know, from there, as a owner of this business, there is no deduction in the revenue because it's all this person's. And then we assume a 50% expense factor. So that's $20,000 in income. You know, from there, like I said, ideally, it's about a 40% mortgage payment just to be safe, but you can go up to an $8,000, which is 40%, to say a $10,000 mortgage payment, which is about 40 to 50%. We can go off of that for the mortgage payment. So follow me again, right? $408,000 a year in revenue over the last 12 months. So that's $40,000 in revenue a month. At $40,000 in revenue a month, they're 100% owner of this business. So that means you're not going to remove anything yet. A 50% expense factor, which is these programs assume half our expenses just right out of the bat. That's exactly what they hit you with from an expense perspective. So that leaves $20,000 a month for income. So we base the mortgage off of the income. So 40 to 50% of that is about an $8,000 to $10,000 a month mortgage payment, assuming no debt. Even if there was some debt, you remove that from this allowance, and the remainder can go to the mortgage. So that $300,000 to $400,000, I mean, an $800,000 or an $8,000 or $10,000 payment. I mean, you're talking $1 million plus, at least, if not more. So obviously, way number one, they showed only $60,000 K1, no bueno. Way number two, went off the revenue. Half of the revenue is the income we give them credit for, so it goes from $5,000 to $20,000 at 4x just in this program, and we can get them $1 million sale price, even more potentially, just by putting them in the right program. Now you say, hey, Andrew, that sounds great, but what if the revenue is volatile? Meaning, say they have some revenue coming in, but it's more of a seasonal business. You know, maybe they own a super high-end landscaping company. So let's look at the P&L program over here. You know, guys, as we're going through this, make sure you go in the description, click the link for our self-employed cheat sheet. It's a lot of stuff between 1099, bank statements, P&L programs. To me, it makes sense, but to you, you may not do this for a living. You might be a business owner, self-employed, but this isn't your world. So go in the description, click the link, get our free self-employed cheat sheet. It's really going to help you out, and that's why we created it. All right, so the P&L program, you know, let's just say, for instance, again, let's go off of 1 year. The last year for a business has been open 5+ years. So let's say in the last 2024, that business made $600,000 in revenue, right? So let's just base it off of that for now. So a P&L program, like I said, maybe this person is seasonal. Let's say super high-end landscaping, like we said. Tons of clients paying a ton of money for some expensive landscaping, but landscaping, especially in New York, is seasonal. You know, in the winter when the snow's out, there's not a lot of landscaping happening, folks, at least that I'm aware of. So this client, with all this revenue, super excited, walks into a bank. The bank takes a look at the 2024 returns, sees the $600,000 in revenue on their tax returns. But guess what, guys? Banks don't look at the top number in your tax return, they look at the bottom number. So this seasonal landscaper wrote off $550,000 in expenses, and so they showed net $50,000, which is about $41.66 a month, which will leave about a $2,000 at best with high credit scores and no debt, $2,000 mortgage payment. It's not going to do the trick, guys, not in this decade, maybe not even this century. So we then move to a profit and loss program. Why? Because this client, if they would apply for a bank statement program, if you think about all the months of the year, right? 1, 2, 3, 4, 5, 6. You figure landscaping, at least in New York, is probably more April, May, June, July, August, September, kind of ends over around here, right? So you have 1, 2, 3, 4, 5-ish, at least 5 months out of the year where there's no revenue coming in. So if this person qualified or tried to qualify for the bank statement program, an underwriter would see 5 out of 12 months. So it's almost half the year. There's no money coming into the corporate account. That's income volatility. Instantly would get denied. Now, a profit and loss program, we would look at the last 12 months. So say in the last 12 months, we don't base it on 2024, especially if it's the summer. So say, for instance, say over the last 12 months, at that point, because we're not just basing it off of the tax return for 2024, if it's now summer 2025, say the last 12 months showed, I don't know, 500,000 of the revenue, it showed 500,000. And of that 500,000 revenue, some of the expenses hadn't hit because expenses depend on time of the year. Maybe they're higher at different portions. But say that CPA said, at this point we only had $300,000 in expenses. So that leaves 200,000. So that 200,000 of profit off that profit and loss, it's over 12, right? Because it's 12 months in the year. So about $16,000 a month of income. Now again, if we're going about 40% of that, that's going to be $6,400 to about $8,000. That's going to be the sweet spot for a mortgage, assuming not that much debt and a great credit score. So even so, a $2,000 mortgage, in the case of this high-end landscaper, follow me, with tons of revenue, but of course lots of expenses, so the natural tax return way didn't work. You have a profit and loss. At that snapshot over the last 12 months, that person had 500,000 revenue and not as much expenses. Some of them didn't hit for the year, so 300,000. So that left $200,000 for the last 12 months in profit. $200,000 over 12 months is, of course, about $16,000 a month, roughly, rounding. And then from there, 40% of 6,400, which is a good sweet spot number, but we can go up to about half of that, which is 8,000. So this is your good sweet spot area for a mortgage payment, which again, this could easily be a $1 million home with 20% down. It goes to show the tax return option, maybe the bank statement program didn't work. You still have an amazing program with the profit and loss. And the difference of these two programs, guys, was only 0.25% in rate. So you go from being declined to being potentially declined again to getting a big juicy approval for a profit and loss program. Turn times are still amazing. There is no catch. There is no predatory, opportunity. There's loans. There's no prepayment penalties. They don't require, you to pledge your firstborn kid. It's an amazing program, and just for a quarter higher in rate, which is somewhat nominal to this type of clientele, they're able to buy their dream home or refinance their house with no snags. Guys, you're now going to want to watch our next video. Self-employed borrowers, are you picking the right mortgage type? This is going to go over all the types of loan products if you're self-employed. It's going to be the full gamut, so you're going to make sure, guys, you want to tune in and check out that video. It's going to be awesome.